a lot of market watchers really scratching their heads right now because it's never happened before. You've got a situation of full employment that's like 3.4%, and yet at the same time, a second quarter of GDP shrinking. That has never happened before. So one way to interpret that is to say the productivity of the 2+ million new workers that have just been booked into the economy must be very, very low. Or maybe they're not really working 8 hours, maybe they're working less, but there's something not working to the traditional model, which is why I think it's giving Powell pause, because he has been jawboning a more dovish Fed, having just done the 75 basis points. Even he doesn't know what's happening here, so he's data dependent. We've never seen this before, never in the history of the economy in 200+ years has this ever occurred. So again, another sign that is not fitting with what everybody wants towards this recession. Well, the narrative towards the soft landing has changed so much in the last 8 weeks, because just 2 months ago, nobody thought Powell could engineer anything like this.
Yeah.
And here we are. It's very hard to call this a recession when you've got full employment. And so is this working? So at least 50% of the pundits or the market now believes a soft landing is possible. Everybody likes to beat up the Fed regardless of who's in that seat. But he's been doing a really good job because, and in my view, because he just doesn't know and doesn't say that he knows what's going to happen next. So he's trying to stay flexible. Rates right now are still at historic lows, even though he's gone through multiple rate hikes. The question is now, what's next? Many people think, well, another one is going to be at 1%. And maybe there'll be an emergency meeting, but I don't think so. He's in the same boat as everybody else, trying to figure out, where are we in this recession? Is it going to be maybe 2 or 3 quarters of slower growth or no growth? We haven't really called it yet because it's so perplexing to have this much employment. For every job, out there in America that is available, there's a ton of people that don't want it. I mean, you can't hire anybody anymore, which is incredible. And, minimum wages in California, $15 for service providers, maybe in the food industry. You can't get anywhere at $15, 21, 22, 23 right now. So the economy is self-adjusting. There is a ton of people that just don't seem to want to go back to work. Well, the truth is in the earnings, and so far, everybody was waiting to see earnings completely blow up. Didn't happen. Many companies delivered, even the highly speculative tech companies, and we're more than halfway through earnings season, and it looks pretty good. Now, it's not as good as it was a year ago, but it's nowhere near as bad as everybody was forecasting, that we would be in the height of a recession right now, and we're not. And so this is a very difficult time to make a decision between fixed income and equities, because we've got an inverted yield curve that's generally never good. But again, when you can't tell me why we have full employment, 2.5 more million people working, and low productivity, then maybe you want to be a little careful about making more decisions about raising rates or changing policy or raising taxes. They all sound like really bad ideas until you've really figured out the riddle of what's going on in this economy. We don't know. My attitude is to stay long equities, continue at a 30% weighting in fixed income. That's very low for me. Usually it's 50%. And just wait and see what happens. My names are high quality names that provide cash flow and distributions. I see Bitcoin sort of testing 20,000 all the time, getting a lot of resistance there. Still very profitable for Bitcoin miners that are currently mining at about 7,000 per coin at scale. And so there has been a knee-jerk reaction against Bitcoin miners lately because of ESG concerns, but they're also self-correcting by getting into nuclear and hydropower, which is plentiful in some countries like Norway. Now, crypto itself desperately needs policy. It needs regulation. But I think there's a 50-50 chance that we will have policy on basically stable coins tied to the US dollar. And let me explain specifically why I think it's going to happen. There is a turf war going on between the SEC and every other regulator as regards to crypto, NFTs, tokens, all of this stuff. And so the smart regulators, the policymakers, are saying, well, wait a second. Let's pick one outcome. Let's just do payment systems, just like a credit card, a Visa card, or a money market fund, which has very limited flexibility in terms of what you can hold in it, basically T-bills and dollar for dollar cash. Same thing with a payment system like a stable coin. If that policy comes down, that's a signal to the market that we're starting to break open the logjam on policy making. And I'm very, very optimistic. Very rare to get all of the policymakers in one room, both sides of the aisle and their staff. This is what they want to talk about, the digital economy and policy on digital currency. But the point is they want policy. We're finally getting something. But I've always said, you're going to get this volatility in the nascent industry that's not regulated because there's no institutional bid. You know, the big players, the big market cap names like Bitcoin, like Ethereum, like Solana, like Polygon, HBAR, you know, in some cases we doubled down. We took advantage of the extreme volatility in the large cap names like ETH and like Bitcoin. Why not add to the position if you're going to stay long? But, you know, everybody trying to manage this space, I don't care who you are, if you tell me you made money in the last 90 days, I know you're lying. You've lost money and you're just averaging down, hoping for this to climb back up. If you'd own these positions for more than 2 years, you're basically in a break-even situation. So this asset class is not correlated with anything, as people thought. It's not correlated with inflation yet, but the real problem, and every time you and I talk about this, it's really a gauge on where the institutional buyer is. And right now, zero. They have no Bitcoin. Anybody that tells you the institutions, the sovereigns own it, is full of poo-poo. I'm in that camp that says dollars, King dollar is going to be stronger. Euro is going to probably, worst case, go to 80 cents. I mean, look, they've got lots of external issues there that we don't deal with here. They have the Putin factor, the energy factor, how screwed up Germany is in shutting down all its alternative power. They did that to themselves. That's a self-inflicted wound. The Ukraine, the grain situation. The market knows all these factors, but it doesn't give you confidence to stock up on euros. And, you know, for me, the way I'm playing it is I'm buying the top 50 European names in their local currencies, in Swiss francs, in euros, and British pounds. Because if you look at a Nestle, or you look at American Tobacco or a Roche, half their sales, in some cases more than half, are in the United States. And now you get to buy them in their local currency at massive discounts, PE discounts, and currency discounts. So why not take down a little bit of Europe? And I've increased that position for me specifically to 20% of the operating company's portfolio. European names, mega caps, big cash flowers, selling at huge discounts. Everybody hates the European zip code right now. I've added a little gold, and I'm using the GLD, which is an expensive ETF, but it's liquid enough. You can put millions in and out in an hour and not move the market. And gold bullion itself, I still keep in storage and pay for the storage. But look, it hasn't worked either. And gold may be the canary in the coal mine that basically tells you that peak inflation has been found. And we've seen it because so much of it is disruption of supply chain and disruption of food supply chains. So right now, gold as an indicator is not doing what it should be if you really believe we're going into hyperinflation. Sounds like gold is pretty proud of Powell and saying, you know what, maybe he's engineered a soft landing because it's not been a great asset class of late. Housing's a tough one. I watch weekly housing blotters, tear sheets, and in some cities, housing pricing is rolling over, and some it's not. Not rolling over in Boston, not rolling over in Miami. In fact, it's up in Miami. Why? The same thing's happening in Texas. There seems to be a bias in housing now to states that are pro-economy, pro-business, pro-low taxes, pro-low regulation. Those are the states of Texas and Florida, Montana, North Dakota. You know, these pockets seem to have really buoyant housing market and rental markets, which is, you've never seen that before. It used to be, you know, New York City and Jersey. I wouldn't want to be long really high-end real estate in New York or New Jersey. There's an exodus out of there. And, you know, this is the competition of policy, and I think it's good. Wait till we see what the midterms are going to bring. The demand for, you know, watch pieces, particularly the brands, Rolex, FP Journe, AP, even Omega recently has had a huge run. Now they're off their peaks, but if you've owned these watches for 24 months, it's still outpaced the S&P. It's still outpaced crypto. It's the best asset class to have been in the last 2 years. Rolex just dropped the new GMT 2 with the bezel on the left-hand side, which is like a funky chicken thing to do. And so it's now been named the Riddler in the aftermarket. You're up 40, 50% if you can get your hands on one, and that's a 2002 release. So there's no evidence at all that secondhand watch pricing is going to have a massive correction. It has gone down 14%. And by the way, I watch these prices nightly. I watch what's going on in watches everywhere. I'm very comfortable it's going to continue to rise and beat the market.